The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome, everyone, and thanks for joining us for today's webinar titled Reconsidering Qualified Charitable Distribution. This webinar will last approximately 20 minutes, and at the end, you'll be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how to email us questions related to today's content. Today's presenter is Linus Sujas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is available now. Linus will draw on his legal, tax, life insurance background, and practical experience for today's webinar. And here he is.
Thanks, Jennifer, and hello, everyone. Thanks for joining us here in this 4th of July holiday week. Today, we're going to reconsider qualified charitable distributions, QCDs, in light of the changes that have been in effect for the past year and a half or so as part of the Tax Cut and Jobs Act. A word of background, I guess. Some of our webinars tend to be very technical, maybe a little bit hard to follow, but I don't feel like today's is in that category. I feel like the information we're going to talk about today is pretty straightforward. I think that many of you will find the information to be of help to you and to your clients, particularly your clients 70 or older, as your clients make plans to manage income taxes and also to meet their charitable goals. Our objective always is to make the content that we provide helpful to you and to your clients, and I hope you find that the content that we provide meets that objective. So just before we get into the meat of today's presentation, let's decide on what we're going to talk about next week, and let's go ahead and open the poll. You can make choices for August's webinar. The first choice is ethical issues with incapacitated clients. The second choice is captive insurance arrangements, and they took another hit. And then the last choice is faulty by self-funding structure leads to litigation. Those are the three choices for next month's webinar. The poll is open. Please go ahead, and I'll give you 30 seconds to cast your vote. Please go ahead. Still waiting on a vote or two. And let's go ahead and close the poll and announce that next month's webinar will be a faulty buy-sell funding structure leads to litigation. Thank you for voting. Thank you for participating, and I'll look forward to covering that topic next month. This month, let's talk about QCDs. Let's talk about charitable giving. So traditionally, gifts to charities that were made in cash generated a charitable deduction. That deduction for individuals was an itemized deduction. For individuals who had itemized deductions that totaled more than the standard federal income tax deduction, they would reap the benefit of the charitable deduction. Charitable cash deductions are limited, had been limited traditionally to 50% of adjusted gross income. That was raised as part of the Tax Cut and Jobs Act to 60% of adjusted gross income. Other gifts that were made in trust, for example, were generally limited to 30% of adjusted gross income, both traditionally and currently. The key is though it's an itemized deduction. Well, what happened as part of the Tax Cut and Jobs Act? What happened was that itemized deductions are useful to fewer taxpayers. The standard deduction was dramatically increased. So fewer individual taxpayers are itemizing deductions, and so fewer are able to take full advantage of charitable gifts. Not saying that that many don't, but fewer take advantage, because if the standard deduction's bigger, they won't get any benefit from making a charitable gift. So what is it about QCDs that make them good? Well, I'm going to go to the end, and then I'm going to go back and cover some of the rules about qualified charitable distributions. The end advantage is this. To take advantage of QCDs, you don't have to itemize. You have money sent directly from your traditional IRA to a charity. You have the custodian do that. You have the money not go through your own hands if you're the taxpayer. And if you are 70.5 or older and you follow that process, then the money that goes to charity does two positive things for you. The first positive thing it does is that it does not hit your income tax at all. So the money that goes to charity doesn't hit your income tax, and you don't have a charitable deduction for it, but you don't need one, because the money that goes to charity from the IRA doesn't hit your income tax at all, and so therefore it's even better than the deduction. And the second positive thing that the QCD does, the Qualified Charitable Distribution does, is the distribution goes towards satisfying the minimum distribution requirements for the account owner with regard to IRAs. And so with both of those positive attributes, it's easy to understand why after the Tax Cut and Jobs Act, qualified charitable distributions are more important than ever as a planning tool for our clients. So let's go over some of the basic rules with regard to QCDs. So the first rule is that a QCD is directly from an IRA, and it is for somebody who is 70.5 or older, and that's actual age 70.5 or older, not just year of RMD. The person who does the QCD has to be 70.5 or older. It is a traditional IRA program. It is not available to an ongoing SEP or simple plan. If contributions are still being made to a SEP or a simple for the taxpayer, the QCD cannot be made from those plans. However, if contributions are no longer being made to those, it is possible to do a QCD from those. It is also theoretically possible to do a QCD from a Roth IRA. We'll talk about that later. And the funds must go directly from the IRA custodian to the charitable organization. The funds must not be filtered through the taxpayer's hands. And so, the question is, why do a QCD? We talked about it generally a second ago, and that is that you don't have to itemize in order to take advantage of a QCD. You can do up to $100,000 per year directly from the traditional IRA to the charitable organization. It doesn't hit your income taxes at all, and it counts towards satisfying your RMD. We get asked a bunch about what the limit is on the QCD, and it's up to $100,000 a year. And I mentioned that traditional IRAs, including inactive SEPs and simples, are valid conduits for making this work for somebody who's 70 and a half or older. It is also possible to do a QCD from an inherited IRA if the IRA beneficiary is 70 and a half or older. That is also a valid way to do a QCD. I mentioned earlier, you don't have to worry about limitations on standard deduction or itemized deductions when you're doing a QCD. You don't have to worry about other income. It just doesn't count at all. And so, from that perspective, it's much easier to do this. One other advantage of QCDs that's indicated on this slide is that if you've got a client who has both pre-tax and after-tax money inside of a traditional IRA, you know that the rule is that distributions from any IRA come out pro rata out of the after-tax money and the before-tax money. And so while somebody who has after-tax money in a traditional IRA will eventually get it back tax-free, it comes back slowly. With a QCD, by rule, the money that goes from the IRA to the charity drains the pre-tax portion first. It isn't pro rata like other distributions. And so if you've got a client who has a high after-tax basis in a traditional IRA, using the QCD method to leak out the gains will allow the client perhaps eventually to have nothing but after-tax money in the traditional IRA, and that after-tax money can be distributed in cash eventually to the client. That'll be tax-free, or perhaps converted to a Roth IRA on a no taxable event basis. If it's all after-tax money, can be converted to a Roth IRA, and the client can transform a traditional IRA to a Roth IRA using that technique. And so we've got very favorable rules with regard to qualified charitable deductions. Now, at Advanced Underwriting Consultants, we often get asked, my client's got a 401k account, my client's got a 403b account. Is the client able to do the QCD from those platforms? And the answer is no. This is an IRA only program. And it's a valid reason for somebody to consider rolling over a 401k or a 403b or other qualified account to an IRA so that the client can take advantage of the QCD program, where the client wouldn't be able to do that from, say, a 401k account. If the client's already 70 and a half and must take RMDs out of an employer-sponsored account like a 401k, the client would still have to take the minimum distribution from the 401k account for the current year and roll over only the rest of the money and be able to take advantage of QCDs in future years. The client couldn't take advantage of the QCD in the current year from the 401k platform. So that's something that needs to be thought about when you're talking to people about whether or not it makes sense to roll over employer-sponsored plan funds. Whether or not they have charitable intent is an important question for you to sort out with them. What is a qualified charity for QCD purposes? It's pretty much any 501c3, including churches. There are some exceptions. A private foundation is not a valid charity for QCD purposes. Neither is a donor advised fund or a charitable supporting organization. Those are not organizations for which you can make QCD direct contributions. Those are important to keep in mind as you work with your clients to decide where the QCD distribution ought to be directed. No private foundations, no donor advised funds, no supporting organizations. As I said earlier, churches are okay in general. Churches are automatically 501c3s. Churches, temples, they work as recipients. I have told members of my own family who are older than 70 and a half, who I know are making contributions to their religious organization of choice, that instead of putting money in a basket every week or sending envelopes or however they make their commitment to their religious organization, that instead of doing that out of after-tax money, they ought to do it from their IRAs, because the family members that I talk to don't itemize on their taxes, and so the recommendation is a no-brainer. They should make their religious contributions from their IRAs rather than writing an after-tax check because it's more efficient. The pre-tax nature of IRA money does not matter to the religious organization because they are not tax-paying entities with regard to federal income taxes. So people sometimes get confused about the tax reporting on QCD distributions. This comes up a lot. We get calls about it a lot. The call goes something like this. It goes, Linus, my client got a 1099-R from the IRA custodian for this QCD distribution. That's a mistake. We need to get the 1099-R fixed, don't we? And the answer is no, that's not how it works. The IRS actually tells the IRA custodian that they should report a QCD as a taxable distribution on Form 1099-R. It's not a mistake. That's how the IRS says to do that. And the custodian does issue that 1099-R showing a taxable distribution. Of course, if the client hasn't been prepped in advance, when the client gets the 1099-R, the client is going to panic and call up the financial professional and say, hey, I thought you said this was going to be tax-free. Why did I get this 1099-R showing this tax result? And the answer is, calm down, not a problem. The instructions for Form 1040 explain to the taxpayer how to reconcile the 1099-R, which shows a taxable distribution, and actually show the lower taxable amount on Form 1040 by following the steps in the instructions for Form 1040. Basically, the client writes QCD on the income tax return and only indicates the taxable amount, the amount in excess of the QCD in the taxable field on the tax form. But if the client has a tax preparer or a CPA, the CPA should be used to dealing with this type of a situation and should be used to dealing with the 1099-R for the QCD. It's only where the client perhaps does their own taxes or hasn't seen this before that you'll run into that issue. So the tip for you is prep the client in advance about the 1099-R. Tell the client that 1099-R showing a taxable distribution, despite the fact the QCD was done, is standard operating procedure, and the actual tax result gets reconciled on the client's income tax return. I mentioned earlier it is possible to do QCDs from Roths or inherited accounts. In general, that makes less sense with regard to a Roth. If the objective for the Roth is for everything to come out tax-free, you wouldn't necessarily want to do QCD from a Roth IRA, although it is theoretically possible. On an inherited IRA, if the beneficiary is older than 7.5, it makes more sense If all of the inherited IRA is pre-tax money, it probably makes as much sense to do it from that platform as it does from a regular traditional IRA. With an inherited IRA, just like a regular IRA, the QCD distribution will go towards satisfying the client's minimum distribution requirement, and it won't show up on their income tax return as taxable income at all. So what's the takeaway here? The takeaway is that particularly for those of our clients who have IRAs and are 70 and a half or older, QCDs are a great thing. If your client makes any charitable gifts at all, it's a no-brainer to make those charitable gifts from the IRA if the client's 70 and a half or older using the QCD technique. Why? Because the client doesn't have to rely on itemizing to get the tax advantage of the charitable gift, and also the charitable gift will go towards satisfying the client's minimum distribution obligation. And so even if the client doesn't need to take the minimum distribution, the client can redirect that minimum distribution to charity and take advantage of the QCD technique. So at this point, I would like to thank all of you for joining us on this short week, and I will turn the program back over to Jennifer to close it up. Jennifer?
Thanks, Lennis, and thanks for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.